Hello, I hope you're doing well and you're ready to learn about receivables today. This is a sales chart from our company. You can see we did okay during the year, but look at the end of the year. So good, our sales skyrocketed. Can you tell why? It is Christmas in December. Our customers buy products from us. Some pay right away, some get some time. This is the same chart for sales. The customers that did not pay right away, we send them a statement to pay what they owe us. Some will pay, some won't. In February we send another statement. Some will pay, some won't. In March, the same story. Usually in business, those who haven't paid for 90 days are most likely that they're not going to pay at all. This is a bad debt expense. We gave them product and they haven't paid. It's okay, it's life. However, we need to recognize this expense and write off the receivable. First, we will use the direct write-off method. We determine on March 31st that company A will not pay us. So this is the entry we need. We debit bad debt expense and we create accounts receivable for company A. We assume we have provided services to company A in the amount of $2,000 on December 30th. This is the journal entry when we have earned our revenue. Company A did not pay until March 31st the next year. We have determined that we cannot collect this account. This is how we wrote it off. But let's take a look again. Using the direct off method means that we do not follow the matching principle. Revenues and expenses must be recognized in the same time period. This way, we recognize revenue in 2013 and expenses in 2014. This means that we have lied to our investors about our true financial position. We do not want to do that. And don't be sad, we'll figure it out. I say, why not make an estimate of how much will be uncollectible? Why not make an educated guess on December 31st and recognize the bad debt expense in 2013? Are we going to be 100% correct with our guess? Absolutely not. But we know that some accounts will not be collectible and we can guess how much. I present to you the allowance for doubtful accounts. It is a Contra asset account. This is the account where we write off the accounts receivable that we cannot collect. Someone would ask me, why don't we simply write off accounts receivable? Why do we have to invent something new? I will give them the answer. We're trying to guess how much will be uncollectible. We're not certain and we cannot know who will not pay. This is why we have invented a general account. To make the estimate, we have two ways, by using sales or receivables. When you use sales, you concentrate on the income statement and you calculate the balance of bad debt expense. Remember this. If you use sales, you can make the estimate as a percentage of total sales. But why so generalized? Can we make a better estimate? Some of those sales were paid right away and some were paid on account. So why don't we make the estimate only on the sales that were made on account? At the end of 2013, we have estimated that 2% of sales will be uncollectible. Sales equaled $100,000. We concentrate on the income statement and therefore we calculate the bad debt expense. Therefore, we debit bad debt expense for $2,000 and we credit allowance for doubtful accounts for the same amount. During 2014, $1,500 from the company A were determined to be uncollectible. Now we write off the accounts receivable from company A and we write it off against the allowance for doubtful accounts. These are the T accounts so you can get a better understanding. When we make our estimate, we debit bad debt expense and create allowance for doubtful accounts. During 2014, when we determine that $1,500 from company A are uncollectible, we credit accounts receivable for company A and debit the allowance for doubtful accounts. We made a mistake in our estimate, and that is how it is in the real world all the time. If you use receivables, you concentrate on the balance sheet and therefore you calculate the balance of allowance for doubtful accounts. Remember this. One way to make the estimate is to calculate the percentage of how many accounts receivables have dues to your company. But maybe many of them will pay. So why not make an aging receivable schedule and see who owes us and the time period they owe us. Someone who hasn't paid in 30 days has the higher possibility to pay than the one who hasn't paid in 90 days. From the aging receivable schedule, at the end of 2014, we have estimated that $2,000 will be uncollectible. Before we make the journal entry, we know that we are estimating the balance of the allowance for doubtful accounts, since we are concentrating on the balance sheet. Since allowance for doubtful accounts already have a balance of $500, the journal entry should be like this. Let's recap. Using the allowance method, you have two ways of making the estimate. using sales or concentrating on the income statement by calculating the bad debt expense, or using receivables and concentrate on the balance sheet by calculating the balance of allowance for doubtful accounts. Please review the aging receivable schedule in the handout for this lecture. Thanks for watching.